Thank you for joining us on our My Wealth webinar. Today we have the co-chief investment strategist of Manulife Investment Management, one of the largest investment managers in the country, Macan Nia. Macan, thank you for coming on. For those who don't know me, my name's Jeff Hunter. I'm part of the Townsend, Samani, and Hunter group at CANACCORD GENUITY. I'm an associate, senior investment associate and portfolio manager at CANACCORD GENUITY. This call is being recorded, so we'll send it to you upon approval and uplisting. So, Macan, thank you for joining us.
Thanks for having me, Jeff.
So obviously lots going on. We've got the elections coming up. We've got interest rate movements. It's almost set in stone in the bond market that they're going to cut in September in the US. We've already cut in Canada. Why don't we just start off with interest rates, given that's the biggest discussion, and a little bit of inflation. It seems like it's way more subdued now. But where do you see things playing out on that end?
Yeah, it's interesting. I was reading an article this morning that said inflation is back to being boring. And what it meant was that inflation is back to levels that make it unexciting. And that is music to all of our ears as investors, because the last couple of years, inflation has been nothing but, I shouldn't say exciting, but it hasn't been boring. But ultimately, what we're seeing is the side effects of interest rates increasing. So I'm going to share a slide with you here. Let me know when you see it. So we know a couple of years ago, Jeff, that there's COVID policies in place. We saw inflation. We saw inflation shoot up to levels that we haven't seen in decades. In Canada and in the US, they shot up to high single digits. And what central banks across the world really started 2 years ago in 2022 is they started raising interest rates, and they started raising interest rates at a very quick pace. And the whole goal of this was to reduce inflation, to really slow down the economy. And we're seeing it. So this is manufacturing. We've talked about this before, Jeff, on these calls, but I think it just shows you the weakness across the world. And this is a gauge of manufacturing. You see the countries on the left-hand side. I'm not going to go into the nitty-gritty of it. All you need to know for those dialed in is green is good, yellow is neutral, red is bad. On the far right-hand.
Just actually, while we have it up, I am noticing a lot of green. India 58, Brazil 54, Saudi 54.4. Then in the more of the Eurozone, less exciting, I guess, would be the red, or not as good, and then moderate around North America. Can you touch a little bit on global economies and what's going on between the two before we get on to
absolutely. So we'll touch on that in the sense that you pointed out those numbers. So I said green is good, yellow is neutral, red is bad. The way this works too is any number greater than 50 means those aggregate companies are growing within that economy. Less than 50 means that they are not. And you highlighted there are pockets of strength from an economic perspective across the world. But the areas of the world that we pay very close attention to is the US, China, and Europe as an aggregate. Why? Because those three zones account for over 50% of global GDP. Yeah, so you pointed, India's doing well, Brazil's doing well, Russia's doing well, Saudi Arabia's doing well. Who cares? Like, from an investment perspective, what matters to investors are those three big economic regions. And as you mentioned, the three of those regions are slowing down. You see Canada here is the third one from the top from a manufacturing perspective. It's deteriorating quickly. And I'm going to quickly go to services, because manufacturing isn't the entire story, right, of the global economy. Services is a big part, especially in economies like ours, developed market ones. And you see the service backdrop is slightly better than the manufacturing backdrop. There's a lot more yellows, a lot more greens. But when we look at this, we anticipate this to slow down as well. So as I mentioned, services is driven by us, consumption. And what factors are consumption? Like, what are the drivers for me increasing or decreasing my consumption? So when you look at it, it's things like employment growth, right? More jobs, more people are consuming. Wage growth. If I'm making more money today than I did 3 months ago, I'm going to spend more. Also, things like credit growth. So credit growth is just a complicated way of saying how much money are the banks lending out. And then last but not least is this notion of excess savings, how much extra savings we have. When you look at those three things together, all of those things are deteriorating. So we anticipate this to slow down. And look at Canada here. Canada, by far, from a developed market perspective, the service-based economy is in a very challenging position. Why I'm bringing this up is we're going to see inflation continue to, be probably trend lower, but we're already in, like, I think US had an inflation data point today. We're recording this on a Friday. It was boring. It's come down to the target range. What does that mean? It now provides the backdrop for the Bank of Canada to continue cutting throughout the rest of the year. And the backdrop is set now. The last major central bank to start cutting rates is the U.S. Federal Reserve, and well, Bank of Japan, but that's a different thing. But the Fed is likely to start cutting in September, and they'll likely continue to cut. When we look at Canada, we have 3 more Bank of Canada decisions for the rest of the year. We think they're going to be cutting at each one because the economy is slowing, employment is starting to deteriorate. So the backdrop is set for interest rates to continue to go down. As investors, why is that great news? As bond investors, because that's a tailwind for our bond investments moving forward.
Well, this is very good, especially when you look at that on the 47.3 in Canada. It's definitely lagging everywhere else. So
Well, Canada was the first, like, this, Jeff. Canada was the first to start raising interest rates a couple years ago, and we were the first ones to cut, and I think we continue to cut. What's interesting this past week is we had bank profits come out for the most recent quarter, and banks are setting aside, they call them provisions for loan losses. What that means is they're setting money aside in the event that consumers default on their mortgages, default on their credit cards, their car loans, but they're setting money aside now. It's a conservative practice, it's a safe practice, but clearly it's highlighting to the market they're seeing things within their own lines of businesses that point to continued challenges for the Canadian economy moving forward.
So going now on to the other highlighted topic is politics. Big election coming on. It was almost set in stone that Trump was going to win. Biden got out of the race. Things have changed a lot. Longer term, it seems that there's not much. There's not a ton of evidence that it's going to make a huge difference in people's portfolios. But shorter term, what are you guys seeing? What are your concerns? Where do you guys sit with this?
For me, the always tongue-in-cheek answer is it doesn't matter. Your clients have made money under Republicans, clients have made money under Democrats. And when you look at, and what I'm showing here is, Jeff, is I'm showing the average return for markets for the broad US stock market, the S&P 500. This goes back to the 40s, this data. And you may say, well, under Democrats, markets do better. And you see that 14.5 versus, I'm going to use round numbers, 11% versus Republicans. And I point out a couple of things with this is, one, ultimately 11% versus 14.5%. Those are great return profiles regardless. So either or, they're great. But also when you look underneath the hood, there's some skewness in this. And what I mean by that is the Democrats have been 2 Democratic presidents, Clinton, Obama. They came in at the bottom of the market during recessions, essentially. And then they saw upside from that. Now, I could make the argument that if it was a Republican president that just so happened to come in, that same type of dynamic would have unfolded. So when we look at politics from an investment perspective, it makes very little difference for any one of us on the call who have time horizons of greater than 5 years or more. Also, look back at our experience. I know there's some concerns with the US election. We don't need to get into the details, those are obvious to many on the call. But look back to 2016. We have a playbook in terms of how that unfolded. And if you there were some concerns about former President Donald Trump being the president, and there's some, concern about US equity markets. And if you would have reacted to your gut based on politics and sold out of your US equities, you would have missed out on the second half of the longest bull market in history. And another reason I don't really pay much attention to politics, Jeff, is who knows what the actual policies are going to be, whoever wins the race. Look at the past couple of weeks. You mentioned in the past 6 weeks, President Biden stepped down. It was guaranteed that like the polls were all pointing to Donald Trump would win. JD Vance comes in. It's just extremely, extremely unpredictable. And who knows what's going to unfold in the next basically 80 days. And ultimately, what I've realized too with politicians and politics is you can say whatever you want to get in, but the realities of governing come into place when you're actually in office. So it's very hard to really, with much accuracy or confidence, pinpoint what the actual policies are going to be at that point. So why would I change my asset allocation, my investments today based on really an uncertainty that I have no visibility over? People ask me, okay, about the US election. My response back is not that I don't care, but from an investment perspective, I care more what Jerome Powell's going to do out of the US from the US Federal Reserve. And I care what the Bank of Canada governor is going to do here, because that's going to be a bigger driver of market returns, is interest rate policy, the health of the economy, than politics and policies, which we really don't know what actual policies are going to be.
Artificial intelligence, we've got the Magnificent Seven. We've got very high valuations in there. There's a ton of hope of continued growth, sorry, in AI, and it's trickle down effects to the rest of the economy. Where do you stand on that, and its impacts on equities, and how do you position people?
Yeah, it's a great question. It's a very valid question. I think with AI, everyone agrees AI will have transformational impacts on economies, on industries, even on our own personal lives, Jeff, right? In terms of ChatGPT in our own day-to-day, it will have an impact. Markets, like they typically do, they get overly excited about these themes, these big themes that are likely to unfold over years, but they action pack it into 6 months of returns. Look no further than the COVID stocks, right? The meme stocks and the stay-at-home stocks during 2020, when the Pelotons of the world, the Zooms of the world, those type of companies, investors looked at their future and said, okay, we're all going to work from home for the rest of our lives. And they took 10 years of potential revenue and they put it into the stock value within 6 months. Look back to the marijuana companies, just general hype, and it's very hard to really live up to the hype. Now, AI will be a bit different, but the challenge now will be is we took all this positivity from that, we packed it into the stock prices. Well, now the companies have to show us, we call it monetization. So now investors are saying, okay, these companies, are you going to be able to monetize that AI trend? We gave you the bump in your stock price because of AI. Well, now you got to show us you're bringing in revenue. And I think you're starting to, there's been some kinks in that armor. The challenge I have with AI, not AI, but with this type of dynamic is from a portfolio construction perspective. So what we're looking at here is this is the S&P 500 return, so the broad US stock market in 2024. The green line is is the total index. So if there's 500 companies within that index. So it's been a phenomenal year for that S&P 500. It's high teens. The blue line is how much of that return is that green line return being driven by 493 stocks. The yellow is the Magnificent Seven, so those 7 tech names. Look at NVIDIA, that's salmon color. That's crazy to me. That almost 18% return for the market, and a third of that's being driven by one name. That gives me concern, right? It's just concentration risk. There's nothing wrong with these names, but I think from an investor perspective, you want to make sure that you don't own too much of it, because you're gonna be rewarded by investing in NVIDIA. And once they're priced to perfection, just a little bit of a disappointment, and you see the stock decline. And we saw that yesterday with NVIDIA's earnings. Blowout earnings, beat expectations, but there's a little sliver of doubt, and that little sliver of doubt, when everything is priced for perfection, you'll see downside. So what we say to investors is, if you are invested in these tech names and you've gone on a run with them, is it doesn't hurt to rebalance. Take some of those profits, recycle them into other parts of the markets that haven't participated, because it's the investing adage, right? You don't want to put all your eggs in one basket.
So on that, how would you view a portfolio? Where would you be wanting to allocate differently? How would you construct it? We see mid caps and small caps having a big dislocation in terms of valuations in comparison to their large cap kind of peers. And we've got internationals that have been very lagging up until the latter, maybe even like month and a half, where they've had a little bit of a pickup. Bonds over the last 3 years have been moderate to low. How do you see things going forward? Where would you position parts of your portfolio?
Yeah, so without putting actual numbers on the asset class, because that is very specific to your time horizon, your risk profile. But broad strokes, when I look at bonds, we like the opportunity in bonds for the very near. If our thesis is that we believe we're getting towards the end of an economic cycle, you typically see this. You go through an economic expansion, and then central banks start raising rates. It creates a slowdown because they want to create a slowdown, and you do get a slowdown or a recession. So I think there's the path of least resistance is likely downwards for stocks in the near term, for the economy in the near term. So does that mean you go sell all your equities? Absolutely not, because your time horizon is not the next year. Your time horizon is the next 5 and 10 years. That being said, I think portfolios today, whether it's from stocks or bonds, to have that focus on quality, right? Quality businesses. And why I bring that up is, if we get a slowdown in a broader economy, I'm not going to sit here, and Jeff, I know you wouldn't sit there in front of your clients and say, your stocks are okay, even if they are high quality. No, the whole market goes down. Those quality stocks, go down less than those ones that have riskier business models, one. And two, during periods like this, I think what's important for me is, I know these stock prices will likely go down. But what matters to me is, I don't want those businesses going away. I want that business to be able to weather a slowdown, because ultimately what happens after every sell-off, you ultimately get a much longer rally. And so I want to focus on companies that have high cash flow or strong cash flow, have reoccurring business, that are less cyclical. They're less vulnerable to a slowdown. So that's one. When we look at globally, what that means is, we still like the US. The issue with the US is those big 7 names have become such big parts of that index, is we like to focus on the rest of the market. So when I say that, is, you mentioned, Jeff, the small cap, right? And that small cap thing never made sense to us, because small caps in general they're not very profitable companies. So when you look at that index, 40% of that small cap index is, we call them zombie companies. They're insolvent. So if you get a slowdown in the economy, they're very vulnerable. We would prefer, from that perspective, you mentioned the mid-cap space. These are companies that are middle. For those that may just go through it, there's large caps, so very large companies. Mid caps, obviously in the middle part of the cap structure, market cap, even small cap. And what's important to note is a mid cap company in the US, a medium sized company in the US, is equivalent to a large sized company in Canada. So it's very different. So a mid sized company in the US would be as big as our big banks. We prefer those mid cap type of companies, right? Because we look at mid caps as not the core of our portfolio. I kind of use the wheel analogy, where basically the wheel, the middle part of it, I can't even forget what it's called now, but that's your core position. So that's like solid companies, and you'll have these satellite positions around it to add extra alpha or add extra returns. And we like the mid cap space because of that. And historically, mid cap does better actually than large cap and small cap. So from that perspective, we still like the US. We like the tech names, but not too much of a good thing is not a good thing. So let's just have a good weighting to tech. Canada, to be honest, will face challenges, I think, in the near term. Our index is very cyclically focused. So it's I don't have to tell anyone, I know you guys are in Alberta, but like you're geared towards, the economy, energy, financials. You saw, like I mentioned, as the Canadian economy continues to slow, the banks will face challenges in the near term. There will be a position for them afterwards, but I think Canada will have some challenges in the near term. And when I look globally, yeah, their international companies are good, but I don't want to buy just countries. I rather have a manager select companies within that country. And then on the other side, we really like bonds in this environment. If you think the economy of the world are slowing down, why? How bond prices work, and you experience this as investors. I experience this is the price of a bond goes the opposite direction of interest rates. So what happened as we were raising interest rates in 2022? Interest rates are going up. What happened to our bonds? They were going down. We all experienced that in our portfolios. Now, fast forward, or even last year, interest rates went down. Your bonds did 6 to 8%, depending on where you're investing. And if you believe that interest rates will continue to come down, which is our case, those bonds will continue to do well. So I think a healthy mix of stocks and bonds is always important, but having a 60-40 mix, having a mix that's geared towards quality if and when stocks decline, that's when you want to become more risky. But I think now you want to be a little bit cautiously optimistic.
This is perfect. Well, I think that's all we have for today. I really appreciate you taking your time. And for those on the call, you'll be getting a replay clip in a couple days. And feel free to reach out to myself, Dave, or Raheem. We're more than happy to talk with you at further length and discuss your situation and help you out from there. Appreciate it, Macan.
Thanks, Jeff, for having me.